Hi. In this session, I'd like to talk about an IPO, and not any IPO. It's perhaps the most long awaited IPO this decade. Airbnb is finally going public. Why finally? Because rumors about it going public have been around since 2016. But on November 16th of 2020, Airbnb filed its prospectus to get the clock started on its initial public offering. Now, the timing is a little strange, right? And why? On November 16th of 2020, COVID cases were rising around the world and economies were shutting down. Europe was shutting down, the US was shutting down. And here you have a company that derives almost all of its value from travel. And it's going public at a time the world is shutting down. Now, in this post, I'd like to talk about why I think the timing is right for Airbnb's IPO and talk also a little bit about how the company is going to be valued and priced in this IPO. Now, let's go back in time. 2007, Brian Chesky and Joe J.B. living in San Francisco at that time, in the midst of a conference, an industrial something conference in San Francisco, realized that there was a business opportunity. People had homes and apartments that some of them were not using, and they said, why can't we rent these out to guests coming to this conference who cannot find hotel rooms? Now that idea took fruition, and in 2008, joined by Nathan, who brought in the technical expertise, they created Air Bed and Breakfast, which shortly thereafter became Airbnb. Over the next 12 years, the company went from one milestone to another in terms of customers and capital raised, and by 2020, it went public. Now, there are two things that Airbnb has faced over its lifetime that I think we need to feature because they're going to become part of its valuation as well. The first is this company has faced legal challenges from cities, towns, and governments across the world. Why? Because with good reason, I think cities believe that Airbnb is violating local zoning laws and perhaps allowing people to evade taxes. Now, Airbnb is pushed back. It's got one of the largest legal teams for a company of its life, its age, and its size. It's pushed back, and like Uber before it, Airbnb is a disruptive company, a company that often acts first and waits for permission later. So you look at Airbnb today, it operates in thousands of cities, but the degree of constraint it faces varies across cities. There are some cities like New York where you have more constraints and other cities where the constraints are fewer. Along the way, Airbnb has invested in its platform. Now, some of that investment has come from internal spending, but a lot of it has come from acquiring small companies. Airbnb has acquired almost a company or two every year over its entire lifetime, usually small companies with technologies that they find interesting. Now, to understand and value Airbnb, you also have to understand how it makes money. It's a very simple middleman model. What it does is it creates a platform where people who have homes and apartments to rent list on the platform, and guests can find the units they want to rent on that same platform. And the original business model that Airbnb had, it charged both sides. It charged the host, the person owning the apartment or the house, 3% of the rental fee, and it charged the guests between 6 and 12% depending upon how long the stay was and how much you were spending. Now, and that basically became the model that Airbnb grew for much of its life. Along the way, in the last couple of years, it's added a new model for professional hosts. Who are professional hosts? These are people who use Airbnb as a platform to run a business, multiple units that they rent out. Think of them almost as the equivalent of small hotels. For these professional hosts, Airbnb has devised a different model where it charges the host the entire fee, 14% of the rental fee. Guests don't pay anything. Ultimately, guests may end up paying the same amount. The way Airbnb collects the fees varies across the two models. Now, along the way, in these last 12 years, Airbnb has accumulated some very impressive numbers. First, it has about 4 million people who list their houses or apartments on Airbnb hosts. They have about 5.6 million units that are listed on the Airbnb platform. And in 2019, I'm going to focus on 2019 for the moment, Airbnb had 54 million travelers on its site who booked in collection 327 million sites. Now, I have to mention that in 2016, Airbnb created a side business model called Airbnb Experiences. Nothing fancy, but what it allows hosts who rent their units out to do is also offer experiences where they might take a guest to a local attraction around town for a fee, and Airbnb collects 20% of that fee. Now, that business hasn't really taken off the way Airbnb expected it to, but it's worth noting that Airbnb still has ambitions for that business. Now, those numbers in terms of hosts and guests has paid off in terms of actual finances. Here you can see Airbnb's numbers in terms of what you see in the financials. First, let's focus in on gross bookings. This is the total rental fee collected from rentals on the Airbnb platform. And that number has gone from $7.5 billion in 2015 to $38 billion in 2019. Now, Airbnb collects only a portion of these gross bookings for itself. That's what comprises its revenues. Those revenues have increased from $919 million to $4.8 billion. If you look at the revenues as a percentage of gross bookings, what Airbnb gets to keep, it's been between 12 and 13%. Airbnb has actually come very close to profitability. In fact, in 2018, their operating profits were positive. So those are all things that I want to focus on because they are going to become the basis for my story. First, this is a growing company, but its growth rate is decreasing. Now, don't get me wrong, a 29% growth rate, which is what it had in 2019, is a very impressive growth rate, but it's down from 40, 50, 60% in previous years, and the reason is very simple. It's just getting bigger. The base is getting bigger. Its revenue share has stayed relatively stable, but here's something to remember. Remember that new business model we talked about, the professional host? That came into being only a couple of years ago, and Airbnb is still transitioning into the model. We still haven't seen that play out. And the experiences business, if it catches on, has higher percentages of revenues. 20% of the gross booking goes to revenues. So this is a number that has been pretty stable but could change in the future. And the company is edging towards profitability. As I mentioned, this is not a company that plays games to show it's profitable. No, by playing games, I'm talking about the adjusted EBITDA number that many tech companies have used in the last few years, where they add everything but the kitchen sink to show you that they're making money. Airbnb is actually close to making real money, and that makes it different from most of its peer group. Now, that was leading into 2020. Well, 2020 came along, and none of us expected to see what we did, which is the coronavirus hit early in the year, start in January. But in January, I think the rest of the world was sanguine, perhaps too sanguine, thinking that this was a virus restricted to cruise ships in China. February woke up to a nightmare, which is the virus was everywhere, and you started to see economic shutdowns. Those shutdowns brought travel to a grinding halt, and Airbnb was affected, not surprisingly. In this graph, you actually see the nights booked and the nights cancelled every month through 2020. Notice what happened in March and April of 2020. Cancellations actually exceeded bookings. In fact, their net nights booked was actually negative in those 2 months. So did the virus hit the company? Absolutely. And March and April were horrendous, potentially catastrophic. Then the company seems to have recovered surprisingly well, not to the levels that it had last year, but surprisingly well given the travel restrictions. Now, this also showed up in the numbers. If you look at the first 9 months of 2020 versus the first 9 months of 2019, revenues are down substantially. Why? Because gross bookings are down from 29 billion to 18 billion. The operating loss is almost tripled. So you might have guessed this already, but 2020 has not been a very good year for Airbnb. Now, when it filed its prospectus, we had a chance to look at Airbnb's detailed numbers because we've had rumors about the numbers, but this was our first look at the full financials. And there's some interesting things that come out looking at these numbers. The first is, as I mentioned, revenues as a percent of gross billings have been relatively stable between 2017 and 19. In 2020, they actually jumped. And that might be an aberration because of the drop in gross bookings that year. If you look at the direct expenses, the expenses associated with actually delivering those gross bookings have been about 40 to 42% of revenues every year except 2020. And 2020 they jumped because again of the virus. And if you look at the non-direct operating expenses and include G&A, selling and product development, there's some bad news here, at least at a general level for Airbnb. Those expenses as a percentage of revenues are actually increasing. You're saying, so what? Well, when you have economies of scale, these expenses should be decreasing. But to cut Airbnb slack, this is a company that's still growing into its public offering. So these items bear watching going forward because this is where the economies of scale will kick in. Now, digging further into the proceeds, there are two other things that are interesting. The first is, while Airbnb did not put a dollar value in how much it expects to raise in the offering day, rumor is that it's looking to raise about $3 billion. That number could shift in the next few weeks, but about $3 billion. And the prospectus actually is very clear about what it plans to do with the proceeds. It plans to use some of the proceeds to pay down debt that it took primarily in 2020. And it also wants to keep the rest for future investment needs. And that's going to play out in my valuation. Now, Airbnb, like many other young tech companies that have gone public in the last decade, has chosen to take the route of having multiple classes of shares. In fact, Airbnb has 4 classes of shares. Class A shares, you get 1 voting right per share. Class B shares, you get 20 voting rights per share. Class C shares, you get no voting rights. And Class 8 shares have no voting rights. Now, the Class A shares are the shares you and I will be buying on the offering date we choose to buy Airbnb. The Class B shares are going to be held by guess who? The founders and the insiders. It gives them absolute control over the company. The Class C shares, there's no plan to actually issue any. So why are they even there? The only rationale I can think of is the founders reserve the right to issue these Class C shares, which have no voting rights, in case they ever feel threatened. The Class 8 shares, I'm going to come back and talk about because it goes with what is interesting about this IPO. And it ties into a broader trend in companies, which is companies want to look good. Remember, I wrote a few weeks ago about the ESG phenomenon, where companies want to sound good, they want to look good, and Airbnb is no exception. And here are some of the things that reveal how far it's willing to go. Brian Chesky, in an interview, said that the corporate values for Airbnb include having an infinite time horizon. Infinite time horizon. I don't even know what that means. And serving all our customers. Who are your customers? Are they hosts? Are they guests? I mean, this is the kind of nebulous stuff that you see in ESG. But for the moment, let's cut Brian some slack. Maybe he means well. In fact, Airbnb actually seems to be willing to spend some money being good because the Class 8 shares that I talked about, Airbnb is expecting to issue 9.2 million Class 8 shares. And the proceeds are going to be set aside in an endowment to serve Airbnb hosts. Now, it's not clear what service Airbnb will provide the hosts, whether it's to give them a stake in the company's success or actually use the funds to cover hosts during periods of need. But it's really a signal from the company that wants to be a good company. I remain skeptical, but I'll hold off because it's entirely possible that Airbnb is one of those companies that actually wants to do good, not just sound good. Now, to value Airbnb, I need to lay some foundations. The business that Airbnb is going after, that it's trying to disrupt, is the hotel business. And here are some interesting features of the hotel business. It is a big business, over $600 billion in revenues in 2019. But it's growing fairly slowly, especially in the last 4 years. And you know who the culprit for that is? Airbnb. It is a concentrated business in the sense that the 5 biggest hotel chains account for about almost 25% of the overall gross bookings in this business. And that market share, that share of the top 5 is increasing over time. And third, right now the US is the biggest hotel market, but China is growing. So with that background, let's take a look at how Airbnb defines its total accessible market. You might say it's a hotel market. Airbnb would disagree. In fact, even early in its life, Airbnb argued that its market was bigger than the hotel market. And its rationale was very simple. It said, we're going to draw in people into this business that's going to make the actual market bigger. In 2011, in a pitch deck to a venture capitalist, this is how Airbnb described its total accessible market. It said there are 1.9 billion trips booked every year. And it looked at Airbnb getting 10.6 million of those trips. This is very early in its life. Its ambitions were fairly small, but it defined the market as a really big market. Of course, by 2020, its ambitions had grown. It had been fairly successful. It had some experience in how many people it was drawing into the market. So in the prospectus, Airbnb defined its total accessible market at 3.4 trillion. Now, 2 trillion of it defined as the hospitality business. The other 1.4 trillion as the experiences business. Now, here you have the hotel business at 600 billion. Airbnb is defining the market at 2 trillion. I think the truth will fall somewhere in the middle, maybe a trillion true, because let's face it, The Airbnb is on solid ground, arguing that it'll make the business bigger. Think of how much Uber has grown the car service business. But I think 2 trillion is a little too high for my, at least based on my judgment. On the experiences business, the 1.4 trillion, given how unsuccessful Airbnb has been in this business, I think this is just hopeful thinking. I don't even think it's aspirational. So the 1.4 trillion, I'm not even sure where that number comes from. But I think this, so let's take it as a given that this is a pretty big market, probably over $1 trillion. Now, if you look at the biggest players in this market, they tend to be hotels. And these are the 25 biggest hotels. And you can see that the margins vary widely across hotels. And the reason is very simple. The original hotel model was a very asset-heavy, capital-intensive model because you had to buy the real estate, build the hotel. Over the last few years, the biggest hotel companies have actually gone to a more capital-light model, less asset-intensive model. And here's how they've done it. They've created separate entities that own the real estate. I'll give you an example. Marriott, for instance, all the hotels are owned by a Marriott REIT, a publicly traded separate company. Marriott itself operates the hotels. It's a higher margin business. It's a hotel business. So margins vary. The median margin across hotel companies is about 14%. And here's an interesting and expected fact, which is 2020, which was bad for Airbnb, was also bad for hotels. During 2020, if you look at the revenue change, revenues have dropped about a third. Not surprising given the restrictions on travel. But if you look at the operating margins in 2020, they reflect the trouble hotels have had in 2020. The margins have dropped from the 11% that you had in 2019, these are the aggregate margins, down to minus 0.42%. So here's the bottom line. When you look at hotels, you have to first recognize what kind of business model have they adopted. The fee-based asset-light model or the asset-heavy model where they own the real estate. And this is a business that is growing fairly slowly. But if you think about it, Airbnb is not really the hotel business, right? They're in the intermediary business. In fact, the two companies that I think are closer to Airbnb in terms of its business are Expedia and Booking.com. Now, for those of you not familiar with these companies, they're pure intermediaries. In fact, let me take that back. They operate in the travel business, but they don't own the hotels or the services they're selling. They act as connecting devices between people who want to book things and the people who offer them. So if you look at Expedia and Booking.com, first look at the gross bookings, and you're going to get a sense of how much these companies have benefited from this large business. Expedia had gross bookings of $107 billion in 2019. Booking.com had gross bookings of $96 billion. Of course, they both suffered in 2020, just like Airbnb. If you look at the last 12 months, the gross bookings have dropped off pretty substantially, more than 50%. If you look at the revenues as a percentage of the gross bookings, Booking.com has a more lucrative revenue model. They get a higher percentage of the gross bookings and revenues and higher margins. Now, to understand the differences between these two companies and how these two companies vary from Airbnb, it's worth noting that these companies, in addition to doing what Airbnb does, which act as an intermediary, which is what they call their agency business, have two other businesses. The second is what they call a merchant business, where Expedia and Booking.com buy hotel rooms from hotels at a discounted rate. They buy big blocks and then sell them at higher rates. They also offer an online advertising business, which Airbnb does not. Those businesses have very different business structures, business models. And in fact, it might explain why Expedia looks very different from Booking.com. Expedia gets a higher percentage of its revenues from the merchant business, buying hotel rooms at a discounted rate and reselling them, than Booking.com. And both these companies, Expedia and Booking.com, are companies that live off the status quo. They get the bulk of their revenue still from the traditional hotel companies. Airbnb is more of a disruptor. So if you were comparing Airbnb to these booking companies, the first is to bring in the differences that come from those other businesses that Expedia and Booking.com have, because Airbnb doesn't. And the second is to recognize that the hotel companies were not afraid of Expedia and Booking.com. They actually, after initially fighting them, brought them into the fold. Airbnb is more scary to hotel companies because it disrupts their business. So I think I'm ready to tell my Airbnb story. This story is, of course, going to become the basis for my valuation. So here's what I see. I see 2020 as a continuing bad year. I think 2021 is still going to be rocky. I think as the world economy comes out of the shutdowns, and it's going to be slow, Airbnb is going to grow in 2021, but perhaps not even to the levels it had in 2019. So 2021 is going to be a rough year. But once that's behind the company, it's going to grow. It's going to grow at a rate that reflects its larger scale. So I'm going to assume it's going to grow. Gross bookings will grow over time. To how much? I'm going to give you a number that I think is based in reality of about $150 billion. $150 billion. You're saying that sounds pretty large. But remember, Expedia already has $107 billion. This is not an outlandish number. I expect Airbnb to continue its gross bookings. I do expect its revenue share, the percentage of gross bookings that Airbnb gets to keep, is going to grow only slightly. Remember, it's been between 12 and 13% for most of the last 5 years. I think it might increase a little bit to maybe to 14%, the experience business kicking in, maybe some benefits becoming larger. I do think the operating margin is going to be the number where you see the biggest difference. In 2019, they had minus 10% margins. In 2020, it's going to be terrible. But as they grow, I think economies of scale are going to help them reduce, not in dollar terms, but in percentage terms, product development, marketing, and G&A costs. That's going to allow their margins to grow. I know that Airbnb is really excited about the experiences business, but I'm not as excited. I think it's going to remain tangential. And this is, for a young company, a low-risk company. It's got a low debt load. It's closer to profitability than most other young companies. So with that story in place, here's how the numbers play out. In 2021, I expect revenues to grow 40% from 2020 numbers. Now that sounds high, right? But growing 40% is going to bring them to revenues of $37 billion, which will still leave them below where they were in 2019. Between 2022 and 2025, I expect revenues to continue to grow. In fact, rather than look at the percentage growth rate, look at the end number. By 2031, I'm expecting revenues of gross bookings of $150 billion for Airbnb. Now, as you go through time, I expect the revenues as a percentage of gross bookings to grow slightly. Remember that part of the story, from 12.65 to 14%. The big shift, the big number for me in this valuation was, of course, the operating margin number. Now remember, they're at minus 13.69% in 2020. I think it's going to still remain negative in 2021. It's going to be a rough year, minus 10%. And the question was, where should I target the end margin? Now, when I looked at Expedia and Booking.com, I didn't focus on these numbers, but Booking.com had margins in excess of 35%. Expedia had margins of less than 10%. That's a pretty big range there. I think that Airbnb, if it succeeds and becomes a steady state company, is going to have margins closer to Booking.com, but perhaps not matching it, because it doesn't have the online advertising business, which is almost all pure gravy. So I'm going to target an operating margin of 25% by 2031. Now, if you look at the tax rate, right now, Airbnb is paying no taxes because it's losing money, and I expect it to be able to use its net operating losses, at least in the near term, to shelter from taxes. But eventually, I assume the tax rate will go to 25%. Now, in terms of capital intensity, in 2020, Airbnb's sales to invested capital, the dollar of revenues they got for invested capital was about 182. And Booking had a sales to capital ratio of 1.91. I think a sales to invested capital of about 2 is roughly what I would expect to see in this business. It's not a capital intensive business. But I think Airbnb will continue to have to do acquisitions. So if you look at the investment, it's going to be primarily in acquisitions across time. Remember in my story, I said it's a low risk company for a young company. It gets reflected in its cost of capital, 6.5%, close to the cost of capital for hotel companies. But over time, you see the cost of capital grow. You're saying, why is it growing? Not because of anything Airbnb is doing, but because I expect the risk-free rate, the T-bond rate, to rise to 2%. In fact, that's the reason I expect growth rate in perpetuity to be 2%. I match my risk-free rate to my growth rate. I'm ready. With those numbers in place, I value the equity. Now, I do think, in spite of its safety, that this is still a young company. Bad things can happen. There's a 10% chance of failure. I incorporate that. And with that, come up with an overall value for the business. Now, the IPO is going to bring in $3 billion in cash to the company. That's going to increase the value of the company almost instantaneously. And with that $3 billion incorporated, the value that I get for the equity is about $37.5 billion. Now, there are some options outstanding. I net them out. Now, the share count is a little fuzzy right now, partly because there was a 2-for-1 stock split leading into the IPO, and the numbers are still in motion. So don't take the value per share too literally, because that's going to depend on a couple of things that happen in the next couple of weeks. The next prospectus is going to give us more transparency in it, but the overall value of equity is $37.5 billion. Of course, that value of equity is dependent on what you assume gross bookings to be in the future and what the operating margin is. To me, those are the two big assumptions. And in this table, I look at what the value of equity in Airbnb would be as a function of those two numbers. So if I have gross bookings, if I expect my gross bookings to go to 200 billion rather than 150 billion, and Airbnb's margin to be 35%, Airbnb's equity could be worth 66 billion. If you believe that gross bookings are going to be just 100 billion and margins are going to be closer to 15%, the value of equity in Airbnb will be 14 billion. The key is the margin number is actually a bigger driver of value than gross bookings. So that's the number I would focus on if I were investing in Airbnb over time, is how quickly they can get on that pathway to profitability. Now, one device I've always used when faced with uncertainty, and I'm faced with a lot of uncertainty here, is replacing my point estimates with distributions. And I took to the three big assumptions, at least from my perspective. The first is the gross booking number. And I allowed the growth rate, my expected value was 25%, but I assumed that in the distribution that could be as low as 15 and as high as 35. Now, with the 15% growth rate, I'll actually end up with less than 100 billion in gross bookings by year 10. If with 35%, I'm going to end up with over 200 billion. So I'm getting a pretty wide range in gross bookings by varying that number. For the margin, my expected value is 25%, but I've assumed a distribution on that as well, where there's more upside possibility than downside. In other words, its margins could potentially get as high as Booking.com, but they could be much lower, 16, 15, even 14%. Now, the cost of capital, my expected value is 6.5%, and I'm allowing it to have a distribution that will allow it to be much lower or much higher, given the spread and the uncertainty I feel about that number. Now, I let the simulation run out. I use Crystal Ball and add on to Excel to do my Monte Carlo simulations. And essentially, you see the distribution of equity value in Airbnb. Now, after the share count gets more precise, I could make this a value per share, but right now I'm just going to focus on my equity value. You'd compare the market cap you see for Airbnb to this number. My median value is 35 billion across 10,000 simulations. My 10th percentile is 26 billion. The 90th percentile is 49 billion. Am I surprised that there's that much of a spread? I'm surprised the spread is so small, to be quite honest, for a young company. But that's revealing of how much more established Airbnb's business model is than Uber or Lyft when they went public. And the lowest and the highest values give you very little. The minimum value is 17 billion. The maximum value is 100 billion. So how does this help you when Airbnb decides to set an offering price? You have to decide whether you want to play the pricing game or the value game. I mean, let's face it, the IPO, when you have an initial public offering, at least for the first few weeks or the first few months the stock is traded, it's a pricing game. What does that mean? Well, nobody cares about value. If you're operating under the delusion that bankers somehow estimate the value for Airbnb, let them go. What bankers are going to try to do is to price the company. And when the company gets traded, initially, the people playing on the stock, investing in the stock, trading the stock, are going to be pricing the stock. You're saying, what does that mean? To price a company, you look at what other companies like it are being priced by the market. You're saying, what are the other companies just like Airbnb? That requires stretching the definition of comparable, right? But usually look at two places for guidance in pricing a company. The first, at the time of the offering, you look at what VCs have attached as a pricing, because remember, VCs, when they invest in a company, price the company. The second is you're looking at the market pricing of other publicly traded companies that you think investors would compare Airbnb to. Both subjective judgments. Let's look at what you learn by looking at those. The VCs have priced the company across multiple rounds of funding, and in this graph you actually see the VC pricing for the company rising stratospherically between 2013 and 16 from 3 billion to 31 billion. Kind of levels off. In fact, in April of 2020, Airbnb at the height of the COVID crisis went out and raised venture capital. And not surprisingly, venture capitalists knocked down the pricing because it was a crisis to 26 billion. Now, if you look at who you'd compare Airbnb to, well, maybe you'd compare to hotel companies. I don't think so, but if you did, you have the six largest US hotel companies, and they trade at a multiple of 27 times earnings or three times revenues or 24 times EBIT. I mean, take your pick on which pricing multiple. I really think Airbnb is going to be priced relative to the big booking companies. Now, the question is, are they going to be priced relative to Booking.com or Expedia? Because those two companies are priced very differently. Expedia trades at a higher multiple of earnings and operating income, but Booking.com trades at a higher multiple of gross bookings and sales. Now, I actually priced Airbnb using both Booking.com numbers and Expedia numbers. And I'll explain what I did. First, I focused on 2019 numbers because 2020 is a disaster for all of these companies. I applied first, so if you take a look at the gross bookings for Airbnb in 2019, it was 38 billion. If I apply Booking.com's multiple of gross bookings, remember it's 0.89. 0.89 times 38 billion gives me 33.7 billion. I'm done. That's pricing. If I apply Expedia's number, which is 0.21 times gross booking, I get 7.9 billion. So 2019 numbers, that's what I get if I use gross bookings. If I use the revenues that Airbnb had in 2009 and applied the same multiple, I get a similar spread. 27 billion with Booking.com, about 9 billion with Expedia. Now, the problem with focusing on 2019 numbers is Airbnb is a faster growing company than Booking or Expedia, and you're not factoring the growth. Here's one simplistic way of bringing growth in. Go forward to 2025. By then, the bulk of the high growth is done. Airbnb's revenues will be 90.5 billion. Apply Booking.com's multiple, 0.89 to that. You're going to get about 80 billion plus as your total value for Airbnb in 2025. Don't forget to value it today. You got to bring it back to today. I use that 6.5% cost of capital we estimated in the intrinsic valuation. Came up with a value of 58 billion. If I were pricing Airbnb against Booking.com, that is going to give me my most lucrative pricing. Use forward bookings, apply the multiple, discount it back. Even with forward revenues, I get 50 billion. Put simply, if Airbnb is priced like Booking.com, I'd expect the pricing to very quickly rise to 40, 45, 50 or higher. If it's priced relative to Expedia, the pricing is going to be much lower. So guess which one you're going to see as comparison when bankers price Airbnb. They want to push the number up. They're going to use Booking.com as a comparison. They're not being unethical. They're basically using whatever is going to give them the higher pricing. So as an investor or a trader, play your game. If you want to play the trading game, remember value is a very minor factor in whether you succeed. Whether you make money will depend on how good you are at gauging market mood and momentum. If you get that by looking at charts, go ahead. But to talk about value, if you're a trader, is kind of a distraction. If you want to play the investing game, then you've got to make your best assessment of value, and it doesn't have to be mine. You can take my valuation, change the numbers you disagree with, come up with your own estimate of value, and then base your decisions on that value. So I'll make this personal. My estimate of value for Airbnb is about 36 billion after the options were considered. If the equity is priced at less than 28 billion, you say, where did the 28 billion come from? When I did my Monte Carlo simulation and a few pages ago, I actually did the deciles, 20th percentile, 28 billion. Then I would view Airbnb as a bargain. I'm jumping on the stock. It's priced between 28 and 33 billion, which is the 40th percentile. I think it's a solid buy. I'll be lined up to buy it. If it's priced between 33 and 38 billion, it's a fair value to me. That's around based between the 40th and the 60th percentile. If it's priced between 38 and 44 billion, which is the 80th percentile, I think it's too richly priced for me. But it might be okay for you with a different story. And if it's over 44 billion, it's overvalued. Would I sell short? My preference is not to play that game with stocks like Airbnb, because momentum will drive out fundamentals pretty much every single day. It's going to be an overwhelming factor. So if it's overvalued, I'll wait. I'll wait for my moment. Remember with Uber, when it went public in 2019, I said I'm not buying. It's too richly priced. 6 months later, it had dropped 40%, and I did buy it because it fell below my value. So I'm going to watch Airbnb. It's a company I like, that I'd like to have in my portfolio, but on my terms. I hope you found this session useful, and I thank you very much for listening.